All right, let's talk about investing. I know. It can sound like this big, complicated, even scary thing, right? But what if I told you it's really just a journey? And today, we're going to give you the map and the compass you need to get started. So, let's dive in. First things first, let me ask you something, and be honest. You work hard for your money, don't you? Of course you do. But is your money working hard for you? It's a really important question to ask yourself, because if it's just sitting there, well, you might be losing ground without even realizing it. And here's the culprit: inflation. You've heard the word, but it's basically this silent force that makes everything, from your coffee to your gas, more expensive over time. So that money you've carefully tucked away in a savings account, inflation is effectively giving it a pay cut year after year. It's like you're trying to run up an escalator that's going down. To actually get ahead, your money needs a job. So what is investing really? Forget the textbook definition for a second. At its heart, it's just putting your money to work. You're committing money to something today with the very real hope that it'll grow into more money down the road. The fancy term for this is deferred consumption. But all that really means is you're saying no to spending, say, $100 today, so it has the chance to become $150 or even $200 in the future. It's a powerful trade-off. And why should you even bother with this? Well, the reasons are pretty huge, actually. You're not just investing for the fun of it. You're doing it for those big life goals, right? Like buying a house or making sure you can actually kick back and relax in retirement. You're doing it to fight back against that inflation we talked about, just to preserve your spending power. And you know, the big one? It's about reaching financial independence. Plus, there are some pretty great tax benefits you can tap into along the way. All right, journey time. Every good journey needs a map, and in the world of investing, our map is the financial markets. So let's get the lay of the land. So picture this: map of the financial world. It's basically got two giant continents. On one side, you have the capital market. This is the land of the long term. We're talking investments that last for more than a year. It's where big companies go to get funding for major growth. Then, on the other side, you've got the money market. This place is all about the short term, less than a year. Think of it as the market for managing everyday cash needs and liquidity. Totally different time horizons, totally different purposes. Okay, let's zoom in on that capital market continent for a sec. You can buy investments in two different ways here. First up is the primary market. This is where investments are brand new, fresh off the line. When a company has an IPO, an initial public offering, you're buying that stock directly from the company. It's exactly like buying a brand new car from the factory. And your money, it goes straight to the company to help it grow. But then there's the secondary market. This is where all the daily action happens, what you think of as the stock exchange. Here, investors are just trading existing securities among themselves. It's like buying a used car from another person. The money just changes hands between investors. That's a really key difference. So we've got our map. Now we need a ride. Let's talk about the different vehicles you can use on this investing journey, because there are a few main options to choose from. Let's break down the big three. First, you've got shares or equity. When you buy a share, you literally own a tiny piece of that company. This is your sports car. It has the potential for really high returns, for going fast, but yep, it comes with higher risk. Then you have bonds. Think of a bond as you loaning money to a company or even the government. In return, they promise to pay you back with interest. This is your reliable family sedan. Much lower risk, way more predictable returns. And finally, you have mutual funds. This is kind of like a bus. A mutual fund gathers money from a ton of people and invests it in a whole big basket of different stocks and bonds. It's an amazing option because you get instant diversification, which is a great way to balance out your risk right from the start. Map, check. Vehicle, check. So how do you actually get on the road and start driving? What are the actual mechanics of making a trade? I promise it's way more straightforward than you probably think. It really just boils down to 4 simple steps. Step 1, gear up. You need to open a couple of accounts. A demat account, which is basically a digital vault where your investments are held, and a trading account, which is what you use to actually place the buy and sell orders. Step 2, place your order. You just tell your broker what you want to buy, how much, and at what price. Step 3, the trade gets executed. Your order zips off to the stock exchange and gets matched up electronically with a seller's order. And finally, step 4, settlement. This is the official part where ownership gets transferred. Those new shares you bought will show up safe and sound in your demat account, usually within 2 business days. They call it T+2. Okay, let's talk about something really important. Every journey has potential hazards, bumps in the road. In investing, we call that risk. But listen, the goal isn't to be afraid of risk. It's about understanding it so you can navigate it like a pro. And you've really got to know there are two main kinds of risk you'll face. First is systematic risk. This is the big picture stuff that affects the entire market. Think of it like bad weather on the highway. A recession hits or inflation spikes. It affects every single car on the road. You can't avoid it. But then there's unsystematic risk. This is way more specific. It's risk tied to just one company or one industry. This is like your car getting a flat tire. It's a problem with your specific vehicle, not the whole highway. And here's the great news. This is the kind of risk you can actually do something about. So, how do you deal with that flat tire risk? Well, it all comes down to one of the oldest, wisest pieces of advice in the book. You've definitely heard it before. Don't put all your eggs in one basket. It sounds almost too simple, but it is absolutely fundamental to smart investing. And that simple idea has a powerful name: diversification. It's your secret weapon. All it means is spreading your money out. Instead of betting everything on one company, you invest in lots of different companies, in different industries, maybe even in different types of vehicles, like both stocks and bonds. That way, if one of your investments gets that flat tire, it doesn't wreck your whole journey. Your other investments keep you moving forward. It is, without a doubt, your most powerful tool for managing risk. So there you have it. You've got the map. You know the vehicles, you understand the basic rules of the road and how to navigate the hazards. Honestly, the foundational knowledge is now yours. Your investment journey has, in a way, already begun, just by learning all this. So the real question that's left is, where are you going to let it take you?